Hello, everyone. Thank you very much for joining me today. This is another Advanta IRA educational webinar. My name is Corey Daharsh, and the topic I'm here to bring you today is rentals versus rehab in your retirement account, otherwise owning rental property versus doing fix and flip real estate deals with your tax sheltered retirement dollars. Again, my name is Corey Daharsh. I've been with Advanta since 2016. I did obtain a industry designation called a CISP, otherwise a Certified IRA Services Professional designation back in 2018, and that does require continuing education credits to keep up to date. So just in my time with Advanta and learning about this industry, I've helped thousands of retirement account investors make any type of investment you could probably think of, from small loans to their friends and non-disqualified family members, all the way up to multi-million-dollar real estate deals. If you have any specific questions I don't cover in today's webinar, please feel free to reach out to me. My phone number and email address are here, along with links to my social pages. I also wanted to share that the copy of today's presentation in a PDF format is uploaded in the handouts tab of your GoToWebinar panel. So if you're interested in the PDF version of today's slides, you can pull that from there. And the recording of this webinar will be live on Advanta's YouTube page within about a day or two. So you should get an email for that if you've registered for the webinar, or if you want to share it with a friend or something like that. It'll be up on YouTube, and you can send the link, watch it back at your own pace, pausing, fast forwarding whenever you need to. And one final item, want to let you know that you will be muted through the duration of today's presentation, but I do encourage participation. So please use the questions box on GoToWebinar's task panel there that you should have on your screen to jot any questions down. I've got that up on a screen here. So if I see a question come through and it relates as I'm presenting, I'll go ahead and pause and answer those. If they don't necessarily relate to the slide or the topic I'm covering in the moment, I will have a section at the end of today's webinar where I'll cover some miscellaneous Q&A type items. And just for a full agenda for what I plan to cover today, I'm going to start out with basics about Advanta IRA and self-directed retirement investing. Then I'm going to hone in onto real estate in an IRA, just some basic rules and transaction overview. I'm going to provide you case studies on making a rental property investment and a fix and flip investment through a retirement account. Then we're going to do a basic analysis of pros and cons of these strategies before closing with final questions and closing thoughts. So without any further ado, I'll go ahead and get started just with some background about Advanta IRA. We are a self-directed administrator of retirement accounts. We've been in the industry for over 20 years now. All of our clients' funds that are not actively invested are insured. So they're held in basic trust accounts, insured. And right now, our total client base has just under $3 billion in assets under management. We fully expect to cross that $3 billion threshold before the end of this calendar year. So it's a great past few years for growth in the self-directed investing space. If you are already a self-directed investor, that's great. If you're just learning about it and maybe are a real estate investor but not utilizing your retirement dollars, hopefully this is some good education for you. And one other piece here, Advanta IRA as a company, we strive to provide a lot of great free education. We never charge for our educational content, and we also strive to have the best customer service in the industry. So when you have an account with us, you actually get paired with a dedicated client account manager. That's a one-to-one person for you to connect with, go over any questions you have, talk through strategies, and even help you through executing investment transactions. Again, I've processed thousands of transactions. I spent about 5 years of my time with Advanta in the client account manager role before I switched over to my current role in the business development team, doing networking, education, and things like that. So just a quick disclaimer, I am here to provide educational content. I am not allowed to endorse or promote any specific product or strategy or opportunity. We always implore you as the self-directed investor to conduct your own due diligence thoroughly, Make sure you have your own team of attorneys, accountants, financial advisors that you consult with before you make any investments. If you need referrals for attorneys or accountants that are familiar with self-directed investing, we do have people that we can put you in contact with. However, once we provide the contact information, obviously it's up to you to decide if that's a good fit to work with. We're not endorsing them per se. We are just saying that maybe they're clients of ours that do those lines of work, or they've been referred or working with us via other clients, so they have a good scope of understanding the legal side or the tax side and accounting side of self-directed investing. So what is a self-directed account? Basically, it's an account where the administrator or custodian is not a fiduciary or a financial advisor and simply allows you to invest into anything you'd like to with your retirement dollars. Most people are more familiar with those fiduciary type accounts where you provide your money onto a platform, whether it's Charles Schwab, Edward Jones, T. Rowe Price, Merrill Lynch, whatever fiduciary custodian you may have, and they invest that money for you. Typically publicly traded assets like stocks, bonds, and mutual funds. Sometimes they even offer a product that they try to call self-directed, but all it is a list of 20 different assets you can choose from. So that's a bit of a misnomer there when people say, oh, I have a self-direct account through Fidelity or through any of those other companies I just mentioned. That is not a truly self-directed account, because you cannot in turn go back to that company and say, hey, I'd like to go buy 123 Main Street, like a physical piece of real estate. They're just going to say that they're not capable to hold those types of assets, which is what we specialize in. Alternative assets, basically anything that you'd want to invest into with your retirement dollars. It's not a publicly traded asset. It's something you'd use a self-directed IRA for. So there are a lot of different types of plans that can be self-directed. Most people are familiar with your traditional and Roth IRAs, but if you're a small business owner or self-employed, you also have the option to set up a SEP, a simple IRA, or a solo 401k. Those plans are very similar, but have a little bit higher annual contribution limit and a few nuances that specify for small business ownership. And then we also offer health savings and education savings accounts if you're someone with a high deductible health policy or a young one in your life that you'd like to set aside a savings account that can be invested, but also money can be pulled out of it for qualified educational expenses. Those types of plans are great for that as well. If you have any questions about any of these plan types, again, just reach out to me and I'll be very happy to speak with you, learn what your needs are, and figure out what the best plan type for your needs and your situation may be. So why do people choose to self-direct? The most common reasons I see people switching over to a self-directed account are that they're either fatigued with the stock market. They maybe have over the past few years seen a bit of a roller coaster ride with the publicly traded assets they've got in their portfolio, and they're just getting tired of it and just not really looking to see the next downturn with their money. The new source of capital is a big reason that people switch over specifically for real estate investing, is if they're already doing real estate investing deals with their savings or by lending and borrowing money, and then they say or learn, hey, I can actually use my retirement dollars from an old employer 401k plan or this IRA I've been contributing into for the past 15 years for real estate investing. It's just a door opener or an eye opener that people just aren't aware of until they learn from someone like me that these are even possibilities. And then the tax benefit. Again, for investing into real estate, a lot of people are not aware, but when you buy and sell property in your retirement account, the IRS basically looks at the retirement account as a disregarded entity for tax purposes. So there's no capital gains on the sale of the property. You're not able to take advantage of depreciation and bonus depreciation like you would if this was a personal investment. So there are some nuances there to make sure your strategies fit with the retirement account model. But for the most part, it's a great tax benefit because you can generate very large profits on real estate that are not subject to capital gains. And depending on the classification of the account, if it's a tax deferred or traditional account, you just pay taxes on that money later in life when you start drawing it out of your retirement account for personal use. or if you've made the investments that we're going to talk about today with a Roth account or a post-tax account, all of the earnings you generate are never going to be taxed. They're all post-tax. You've already paid taxes on the money that's in that account, so it grows completely tax-free with a Roth, either IRA or a Roth solo 401k. Now, I do want to share how easy it is to move funds into these types of accounts. A lot of people think it takes a long time, or there's tax reporting or taxable events taking place. So I just want to break that misnomer as well real quickly. The two key ways people fund these accounts and get started with self-direction are going to be a custodian to custodian transfer or a direct rollover. So a custodian transfer is basically when you have an IRA, whether it's a traditional or a Roth IRA or a SEP or a simple IRA, and you just want to move that money into a self-directed version of the same type of plan. That's just a custodian transfer. You complete a transfer form for the company that's going to receive the money. You provide that to them and they submit it over to the company that's currently holding your money. And that's usually facilitated with a wire within roughly 3 to 5 business days. Some take a little bit longer, but that's what we're here for. Once you tell us in the onboarding process what company your funds are currently with, we can tell you exactly what the nuances are, if they have any, regarding moving the funds over. And the other way that people fund these accounts are rollovers. So what a rollover is when you've got a employer sponsored plan like a 401k or a 403b or a thrift savings plan if you're a government employee. And typically when you leave that job and are no longer employed by them, you're allowed completely to move that money wherever you'd like to. So you initiate a distribution out of that employer sponsored plan and roll the money over into another qualified retirement account, which does generate some taxable reporting. So the distribution out of the first plan is reported to the IRS on Form 1099-R. But as long as the full amount is rolled into a qualified plan, there is no taxable event occurring, and the money pushing into another qualified retirement account is reported to the IRS on Form 5498. So think about a seesaw. As long as the numbers match on 1099-R and 5498, there's no taxable event taking place, and you're allowed to do a direct rollover as often as you may need to. There's one other nuance called an indirect rollover. That is where you can take money out, use it for personal purposes for up to 60 days, and then deposit that money into a qualified plan. You're only allowed to do that once every rolling calendar year. So keep in mind, if you wanted to do that 60-day rollover, you can only do that once every rolling calendar year. So if I did it tomorrow, I would have to wait until April 19th of 2025 before I'm allowed to do that again. The only other nuance with rollovers I wanted to bring up, I mentioned earlier that this is typically, for the most part, when you have a previous employer plan. Sometimes if you're still employed, you can do a rollover out of your employer-sponsored plan. The specific question you need to ask is, are you eligible for an in-service rollover? That is the specific term you want to ask your benefits department or your retirement account company. And if you are eligible, you can basically break off a chunk of your retirement account over there and move it over to a self-directed plan so that you can start doing these types of investments. So the rules around what you're allowed or not allowed to invest into are very simple. The IRS simply states that you cannot invest into life insurance policies or hard to value collectibles like antiques, fine wine, artwork, anything they would think as subjective in value are things they don't want you to hold in your retirement account. So that's basically it. Anything else you know how to make money doing, there's usually a way, after speaking with a client account manager, to structure that investment through your retirement dollars. The other aspect is labeling certain individuals as disqualified persons to your retirement account. And that's basically your family tree, but only the main trunk of the tree up and down. So we're looking at yourself and your spouse, your parents, your grandparents, your children, your grandchildren. Any businesses that those individuals own or control daily operations of are also extensions of the disqualified persons rules. So you're not allowed to transact with those individuals. You can partner with them, but you cannot sit on the opposite side of a deal from them. And I'll go over with a few examples in a few slides what that means and what the nuance there breaks up. Here's just a quick visual representation of the disqualified persons. So again, we're looking at ourselves, our spouse, everyone up our direct family tree and everyone down our direct family tree. Notice this does not include siblings, aunts, uncles, cousins. Those are not considered disqualified persons. I do see a question coming in about in-service rollovers. I'll pause real quick and go ahead and review that. Is in-service rollover different than in-service withdrawal? I presume so, but I've only seen and advised to do an in-service withdrawal to even do a Roth conversion. I'm not necessarily familiar with the term in-service withdrawal, but that seems basically like the same thing. It's basically the first half of a rollover. What you do is you do a in-service distribution request, which would be the withdrawal side of it. And then the rollover side of it comes in play when you actually deposit that money back into another qualifying account, or even really into the same account in the case of maybe doing a Roth conversion if you're just switching the tax classification of a portion of your funds. So I believe that they are pretty much the same. If that individual wanted to reach out to me after the webinar, I can get further clarification and make sure we give you a solid ironclad answer. So again, prohibited transactions, just a few examples here, specifically relative to real estate. With the disqualified persons, my IRA cannot purchase a piece of real estate from my son. If my IRA owns a piece of real estate, the tenant in the property cannot be my daughter. If my IRA purchases real estate, my son or his company cannot perform work on the rehab. So we'll cover that a little bit more thoroughly in my case study later. But disqualified persons are not able to do any of the work on the property. And again, that's some nuances that I'll cover a little bit later when we get into more of the real estate rules and regulations. So when we're talking about real estate investing, there are a number of different choices. A lot of people are familiar with just a single family rental or a multi-family home. You can do real estate syndications where you're just a limited partner in a larger deal that a general partnership team is taking care of the day-to-day operations of. You can joint venture, you can do option contracts or basically wholesaling. Tax deed and lien investing is a great strategy for those just getting started with retirement dollars and don't necessarily have enough to go out and buy a physical piece of property or any land or anything like that. And then lending, you can actually be a mortgage lender through your retirement account into these types of investments and asset classes. It's very important with self-directed investing to make sure you invest with people you know. We're talking about real estate here. I'm sure you've got a local RIA group close to you or meetup groups for real estate investors, but always go out there and network and build your network so that you know who may be a great person to partner with, who may be a not so great person to partner with. Because again, as I covered at the beginning with my disclaimer, when you're self-directing, you are in control and making the final decision when you execute an investment transaction. So if anything does not go to plan or expectation, it really falls on your shoulders as the self-directed investor for maybe not having done as thorough due diligence as you could or should have done. So again, I just want to make sure I stress that it's very important with self-directed investing to have your triangle of know, like, trust in your network and work with those people as thoroughly as possible. And I'm sure that that will end up yielding great results for not only you, but for them. And then it may bring more deals to your table as well. So I'm not going to sit on this slide too long, but real estate asset classes is breaking down a little bit further in a little bit different way. Single family homes, whether it's for a short term, a long term, or a rehab project. There's also an emerging market for mid-term rentals for contract workers that are out there, maybe serving 13 weeks in a specific city and then moving on to a new area. So that's an emerging rental market as well. Condos, mobile home parks, or even a specific mobile home unit, and a few of those other asset classes that I already referenced as well. So let's dive into a little bit further buying real estate. So whether you're doing a rental property or you're doing a fix and flip, you first have to buy the real estate in your retirement account. So what a self-directed investor will do is they'll go out and they'll prospect properties. And when they're ready to make a property purchase, they put an offer in on the property in the name of their retirement account. So in this case, Advanta IRA, for the benefit of John Smith, IRA number is going to be the buyer on the deed of title. All of the funds for this property purchase needs to come from the retirement account. This example in today's presentation is pretty general. We're talking about just a purchase directly with one investor. You can partner multiple investors together. In that case, each of the ownership percentages on the deed of title are going to be based on the total dollar amount that's being brought to the closing table for the final closing cost. So it will be directly tied through how many dollars you bring towards that final closing cost, breaks down what your ownership percentage is going to be. And furthermore, all the expenses and income will need to be split by that ownership percentage moving forward as well. So just briefly explaining that to the audience here, but we're not going to look into that too much further. Most of my examples today are just, hey, my IRA is buying a piece of property outright on its own. All income and rent, sale equity, anything that's generated will flow back into this retirement account tax-free. So it may be tax deferred, where you have to pay taxes on that money later if it was in a traditional or tax deferred account, or completely tax-free, meaning you never pay taxes on it if it was done in a Roth account. So paying the bills, when you own a property in your retirement account, as I just mentioned, all the costs associated need to come out of the retirement account, or its portion if it's a split property. The way Advanta typically handles this is that we can have an authorization on file for your recurring utilities, so that the utility company sends those bills straight to our office and we process them as long as you have the cash available in your account without having to reach out to you and verify further. When you have one-off expenses or you're working with vendors or something like that, you basically submit the invoice to us with our purchase authorization letter. You can do that via email or just go to your online portal and plug that information into your system to submit to us. And we process a check basically the same or the next business day when that request is received. So it's very simple and straightforward. We can also process ACH and wire. That's handled a little bit differently. Standard protocol is basically cutting a check and sending a check out via mail. Maintaining the property, or in this case, potentially doing the work on the rehab. Who can and cannot do the work? Again, this goes back to the disqualified persons rules that I referenced earlier. When you own property in your retirement account, you are seen as a disqualified person and your relatives that I referenced, so they cannot do any sweat equity, any manual labor. That even includes like mowing the grass, painting the walls, changing a light bulb. All of that should be done by non-disqualified persons. It does not have to be a qualified, licensed, insured individual. It can just be a local handyman or any non-disqualified person that you trust to do that type of thing. You are allowed to be on site at the property to inspect the work or watch over, but you should not, again, be doing any sweat equity of any kind. So if you're going to rent the property, you basically control the terms of the rental agreement. So whether you want to work with a property management firm or you want to handle the rental yourself, just kind of as a pseudo property manager yourself, that's all perfectly fine. You set the terms, so you decide who you want to use the property, what the rate's going to be, what the length of the term is going to be. You basically have that all drafted up, provide it to Advanta showing that your IRA is the property owner. You approve that paperwork, your client account manager gets it executed, and then again from there on, we handle taking in the direct receipt of the proceeds and profits generated from that rental income. Or if you choose to, you can have a property manager handle that, be the middleman, and then they just send residual profits back to Advanta on what could be a monthly basis, a quarterly basis, and semi-annual basis, whatever you determine is the best for your dollars. All right, so we're going to turn our attention to two simple case studies. These are case studies I've used with rounded numbers, but they are pretty reasonable figures for these types of investment strategies. And then after these case studies, we're going to do a pros and cons. And then I'll finally answer any last questions and just kind of give a bit of a closing statement and sentiment for the webinar today. So I've got a gentleman, John Smith, who's got some money in an old employer 401k, and he finds a property down the street from his house he thinks would be a great rental property. So he sets up a self-direct account, makes an offer to purchase that property. In this case, the property was valued at $200,000, or at least the agreed purchase price was $200,000. He makes the offer, submits the purchase authorization paperwork, marks everything as read and approved so that Advanta can execute the closing transaction, send the executed paperwork to the closing attorney and the wire to the closing office at the transaction date. From there, we will take in all of the original recorded paperwork for the property purchase and then facilitate the income and expenses for that rental property moving forward. So the strategy here is that the property was rented for 2 years at $1,500 a month. That's $36,000 of rental income generated. After 2 years, John decides he wants to sell the property. Maybe he's moving away and going to be further away from that property himself, so it's no longer the best asset for him in his retirement account. But the property's appreciated some, so he actually sells it for $275,000. So that generates another $75,000 in profit. So in total, about $111,000 of profit were realized, not subject to capital gains tax, and that flows right back into his retirement account, whether it's tax deferred or tax free, so that he can decide what next deal or deals, plural, he may want to do with that $311,000 total. I see a question that came in. Can I transfer ownership of an existing property owned by an LLC into the IRA? If you own a property personally through an LLC that you control, manage, or own, then no, you cannot push that into a retirement account. The only type of asset or funds, for that matter, that can be pushed into a retirement account right now based on the IRS rules is going to be cash. So you can make a cash contribution, you can transfer cash, you can do a rollover of cash from existing retirement accounts. But if you own an asset personally, whether it's through an LLC or just, hey, my single family home that I own and my family resides in, you cannot push that into a retirement account. The subtle nuance I bring up there is that if you're doing partnering, maybe you set up an LLC with your retirement account where your retirement account invests into an LLC cash, and then you have a business partner that you're going to joint venture with that contributes a property into that LLC. And then between you and that partner, you use the cash that you put in there to upgrade the property, and then you have a joint venture agreement so that you know how the proceeds and profits are going to be handled when you sell the property. Really jumping ahead into a case study for fix and flip, but I wanted to give a thorough answer to the person that asked that question. No, you should not be putting existing owned property into a retirement account. That is not allowed within the IRS rules. So case study number 2, purchasing real estate for fix and flip. So in this case study, I've got a gentleman named David who finds a distressed property in his community, and he decides he would like to make an investment of that property because the location's great, there's a lot of job growth in his area. He thinks he's going to be able to pretty easily make a good profit on that property once he tunes it up a little bit. So he makes an offer to purchase the property for $150,000 and expects about $25,000 in upgrade costs. Because this is a cash deal, he's able to close very quickly and begin the rehab project through his retirement account. Again, all sweat equity must be done by third parties, so he's connected and has the appropriate network in his range of the area and through his networking groups and so forth to get this all scheduled and done pretty quickly and efficiently. So who does what in the fix and flip scenario? David, very similar to John on my last presentation slide, on my last case study, is going to find the property, make the offer to purchase the property in the retirement account, and approve all the closing paperwork for us to execute the transaction. He's then going to negotiate and hire the contractors to do all the rehab work. Again, he can be on site to inspect the work and verify before he cuts any payment out to them that it's all done up to his standard. And then once the property is rehabbed and ready for sale, David is going to coordinate with an agent or a broker, however he wants to do so, to list and sell the property. Once terms are agreed on, he has to provide authorization or approval to Advanta to actually execute the sale transaction. On Advanta's end, we're going to ensure proper titling at the time of purchase. We're going to sign all the executed documents and take in the deed once it's recorded. We're going to remit payment to all the vendors throughout the rehab project, and then we're going to facilitate the sale transaction and take in all the funds from the sale proceeds once this flip goes full cycle. So the outcome of David's flip. David invested a total of $175,000. Again, it was $150 for the actual real estate transaction and $25,000 in rehab work costs. After the rehab's done, he sells this property for $225,000. All of the proceeds go right back into David's retirement account. The $50,000 of profit generated will either be tax deferred or tax free, again, depending on the type of plan he utilized, and there's no capital gains associated with the investment. He can now take this $225,000 toward another flip, break it up into multiple investments, however he would like to do so. I do want to express that the IRS does not have a specific rule on how many flips you're allowed to do with any given year, but they do indicate you're not allowed to run an active business through your retirement account. So if you're flipping upwards of, let's say, 5, 6, 7 houses in a physical year, in a smaller time frame, that may constitute running a flipping business. So there is a type of tax called UBIT tax, or unrelated business income tax, that may apply when you start to scale and flip a lot of houses through your retirement account. If you're in a threshold where you think you're going to be flipping 5, 6, 7 houses in a calendar year, we just implore you to speak with your own CPA or tax advisor or attorney that's familiar with these rules and regulations to verify if UBIT tax is something you should prepare for and submit to the IRS, or if with their professional opinion, they think you're not at the threshold of actually running a functioning business and generating active income as opposed to passive income. Because in itself, at its core, these retirement accounts are set up with the intention to generate passive income for your future self or your retired self. I do see a few questions came through here as I was on the last few slides. Let me go ahead and take a second to read those. I deposited 100K into my Advanta account. Can I use all 100K for an investment into real estate? Yes, we do not have an account minimum. So you can use every dollar and penny that you have in your Advanta account towards a deal. The one word of caution I'd say with that is if you have exactly 100K and you do not have other retirement accounts to move money into from, keep in mind all the expenses for this property has to come out of the retirement account. So I wouldn't go buying a $99,000 property, because if you buy that property and a week later realize you need to put a new roof on it or have any other major expenses, you don't have the reserves to go ahead and pay for that. So you're kind of in a bind until you can either make a new contribution, do another rollover, do another transfer into the account. So it's all part of your strategy and underwriting as a self-directed investor to decide what value of properties I can really afford with any potential rehab work or having reserves for any worst case scenario events that take place if any expenses come up. So Advanta acts as the title company in purchase/rehab transactions. Well, not the title company. The title company is still the real estate agent or agency in place. We act as the administrator. So your retirement account is held through Advanta, and that retirement account is going to go execute the investment and buy the property. So we facilitate on behalf of your retirement account properly purchasing the property and properly paying the vendors when you're doing the rehab work or taking in the income when you have a tenant in the property. Our role is more so, again, the administrator of your retirement account that owns a piece of real estate. Is anything different if you have a checkbook IRA? Pretty much no. All of the principles I've talked about today are going to be the same, whether you're doing it directly through your retirement account administrator, like I've given my case studies here, or if you set up what's known as a checkbook IRA or a single member LLC. For those of you that are not familiar, it's basically when you use your IRA account to set up an LLC, invest into that LLC with your retirement account so that the retirement account is the only member and you are the manager. And then you do everything I've described today in the name of the LLC, as opposed to in the direct name of your Advanta IRA account. We've got plenty of educational content on the checkbook IRA strategy. If you're interested in that, you can check out our website or our YouTube page or email me directly, and I can give you some more information on the checkbook IRA strategy. If a family member is selling, could I buy the property and accept a quitclaim deed in the name of Advanta IRA account? You can only do that if that family member is not disqualified. If it's a disqualified person, as I covered a few times in today's presentation, you are not allowed to buy that property. Who is contract buyer if IRA is checkbook trust? The trustee how exactly to title the contract and the deed, i.e. trust, FBO, IRA. If the IRA is a checkbook, you title the transaction in the name of the LLC. If you have a trust established, typically the name of the trust is going to be the asset that Advanta holds, the investment into the trust. So the purchase of the property would either be through the trust directly and the IRA is invested into the trust. We don't necessarily set up a trust as an account type. So that question may be a little bit nuanced that I'd have to get further information on to give it a more definitive answer. But if you're investing into a trust, like a real estate land trust or one of those types of assets, that's actually the investment the IRA makes. In the trust is held the piece of property. So the property itself may be titled in the name of the trust, but the retirement account is an investor into the trust directly, if that makes sense. If not, I implore that person to reach out to me directly, and I'd be very happy to clarify further and answer any additional questions. Turning back to the presentation, we do put on a lot of educational content. We do these types of webinars twice a week, every Tuesday and Thursday. You can find our full video library of these webinars on our YouTube page. We have a blog with industry news if you're interested in that. We also have a podcast called the Alternative Investing Advantage Podcast, hosted by my colleague Alex Perney. And finally, we have a networking event called Pitch, Promote, and Prosper that takes place every final Friday of the month, with exception to any holidays that may come up. And that event is where every person that's on the call gets a chance to say who they are, either what investments they have to offer, what investments they're looking for, and just network from there. It's a very collaborative environment. We encourage helpful conversations on retirement investing topics. So please feel free to check that out. Pitch, Promote, and Prosper. You can find all of that on the events tab of our AdvantaIRA.com website. So just closing out and final thoughts here on pros and cons for rental real estate versus rehab real estate in your retirement account. When we're looking at rental, the pros are that you get cash flow that is tax deferred or tax free. So you're getting a monthly payment into your retirement account. You can dictate those terms. So if you want to be a short-term rental person and maybe have a vacation property, if you want to have a long-term rental tenant, or maybe midterm like I referenced earlier, you can utilize different services like HUD, like the Housing Authority, where they help place tenants into your property and maybe cover a portion of the rental income so that you're supporting some of those people in your community that may need additional assistance like that. And then the rental property is going to have long-term appreciation in most cases. So you'll be able to, when you're ready to sell the property later in life, generate a decent amount of return on the sale of the property above and beyond what you generated while it was actively invested and being rented out. The cons are that holding a piece of real estate is more so an illiquid asset. So if you're reaching required minimum distribution age and you don't have too many other retirement account assets or cash, you may be subject to starting to take personal ownership of a portion of that property periodically, or find other creative ways to satisfy your required minimum distribution. You're going to have to deal with home ownership maintenance. You may have a toilet that goes bad, or the air conditioning unit goes bad, or a new roof. Those types of things could come up as costs. So make sure you're doing your due diligence when you make the purchase at the outset. And then dealing with tenants or property management, if you're not going to deal with the tenants directly, sometimes that can be a con. Hopefully everyone that hears this and is doing this type of investing has great tenants, but we know that's not always the case. So for fix and flip, the pros here for fix and flip are that you don't have tenants or rents to deal with. You can have a relatively quick investment turnaround because, again, it's a cash real estate transaction, so you're able to close pretty quickly as long as you have a good network of the individuals and vendors that are going to do the rehab work or provide the materials for the rehab. You can pretty much get this turned around as fast as that can all get done. And there's no capital gains tax when you sell that piece of property. The cons to fix and flip in your retirement account are, again, no sweat equity. So you have to be hands off. You have to have some third party, whether it's a handyman or vendors that you network with doing all the work. You do have to do the hiring and managing of those vendors, so a little bit of kind of contracting or general contracting pseudo work that you're going to have to do. And depending on the scale of how many properties you're actually doing flipping throughout a given year, you may be subject to UBIT or unrelated business income tax with this investing strategy at scale. So it's real easy to get started with a self-directed account. I covered that earlier, how fast you can get these accounts funded and set up. The application itself only takes about 15 minutes. I typically send that out via DocuSign. It's very easy. Once your account's open, you get paired with an account manager that helps facilitate your transactions. Getting the account funded takes about a week to a week and a half, depending on where the funds are coming from. And then you could start making your investments. You could, in theory, open an account today and start putting offers in on properties tomorrow in the name of your retirement account, and then be ready to close within about 2 weeks, 3 weeks, whatever's necessary for your funds to get moved over, and the due diligence period and so forth as well. Again, I've been Corey Daharsh, your presenter today. I'll leave my contact information up here on this final slide for just a moment while I look through any final questions that have come through. I appreciate you all for sticking with me for today's webinar. And again, if I can answer any further questions, please reach out. You can get the copy of today's presentation in the handout section or by emailing me directly. And I look forward to seeing you on our next educational webinar. All right, so just looking back at the questions box, is step-grandchild a prohibited party? It's a bit nuanced of a question. The most similar thing I could relate to that is just a stepchild. And if the stepchild is an adult, or in this case, maybe the step-grandchild is an adult, and you have never been financially responsible for them, then that leans in the favor of not being prohibited. But if you've ever financially supported this individual, whether it's a son-in-law or a stepchild or a step-grandchild, then they lean towards prohibited in nature if you've ever financially supported them or they're set to benefit from your retirement account. Is this step-grandchild listed as a beneficiary, or are their parents listed as beneficiaries to your retirement account? If so, that leans in the favor of that person being prohibited from this type of investing. I would implore that person to seek proper legal guidance and counsel on that question, just because it is a bit nuanced and it really depends on the specific relationship of the step in that grandchild situation. All right, and it looks like that's it. So I'm going to go ahead and end today's webinar. Again, thank you all very much for participating today, and I hope to see you next time.